What's up, y'all? Appreciate you tuning in. Today is Monday, March 10th, 2025. My name is Luther. I'm a real estate pro here in the Kansas City area. And in today's session, I want to talk more about capital when it comes to real estate investing. All right. So if you're tuned in, there's a good chance that you've invested in real estate or you're looking to do so, or you might be a real estate practitioner that perhaps has worked with investors and maybe you want to look to grow your investment portfolio or do some fix and flips on your own. So this might be helpful to all those folks, all you out there who might be interested. All right. So how we've placed capital over the last several years, me and some of my clients, and I'm going to assume first off that you or someone close to you has a certain amount of capital that you want to utilize. And your plan is to do it somehow via real estate, okay? And so two ways that I've done it and a bunch of my clients and colleagues have done it is either through joint venture partnerships or through private money lending arrangements or private money loans, okay? So first off, joint venture partnerships. Second one, private lending. All right. So I had a call last week with an investor, and they have a certain amount of capital, and they, want to be more hands off, and they wanted me to put something together. So I was like, hey, just give me a couple days. I'll update my PowerPoint, and I'll send it over to you. You can have a conversation. We can kind of go from there. So I'm going to dive into both of those, joint venture partnerships, how that might look, how we've done it, and then also how we've worked with private money lenders, okay? And you might be able to do a similar type of thing, all right? So, and I'll get into some of the pros and cons of each too, right? So for joint venture partnerships, I did a couple videos where I've gone deeper into what a joint venture partnership is and different ways that you could place capital. So I'm just going to do kind of an overview here of how that might look, at least how we've done it. All right. So for the joint venture partnership, I've aligned myself with someone who has a certain amount of capital that they want to invest. Okay. And with the joint venture partnership, in our case, at some point, usually early on, it might not be right off the bat, but at some point an LLC gets formed between me and that capital investor. Okay. And for that LLC, we might split it 50-50. It could be 60-40. It could be a different ownership split for that entity, okay? That LLC gets formed and we go through the whole process, with an attorney. A lot of times when we form our LLCs, we use an attorney and they get together all the documents and then they assist us, make sure that we have the EIN number. And then from there, once the LLC docs are good and we have the EIN number, we can open up a business bank account, and then the capital investor can move money into that business bank account. And then from there, the investor and I can determine, well, hopefully before then, we've determined how we're going to place that capital. Okay, so that's a little bit on joint venture partnerships and how that might look. Okay, and I'll come back to it in here in just a few minutes, but I want to go over private lending arrangements. Okay, so let's use the same example where that couple or that person that reached out to me has a certain amount of capital that they want to invest. With the private lending arrangement, the capital investor does not get ownership of the property, okay, but they are going to place capital and they may loan that money to me, and I can use my LLC and I can use that capital to purchase property, okay? So, or I might use that capital to loan it to another investor type of thing, all right? But I'm getting that money from a capital investor, and it's set up to where it might be unsecured, but there's a very good chance that the money that they loan me is gonna be secured by the property in either first lien position or second lien position. In some rare cases, we have done it where investors have loaned money to us unsecured. We've been able to make that work as well. Okay, so that's on the private lending aspect of it. So those are the two main ways that when investors reach out to me and they want to place capital or they want to invest, that's how I've done it and how I'm continuing to do it, looking to grow our portfolio going forward. Okay, so depending on the amount of capital that the capital investor has and their risk tolerance, okay, and then how long they might be able to, or how long they can leave that money invested, will help us determine what's the best way to use it. Okay, so back to the joint venture partnership. This is what we lean towards, or at least what I lean towards the most, because I believe it's the safest and securest, or at least one of, it's a very safe and secure way to do it. Okay, and with the joint venture partnership, let's say that the capital investor has $200,000. Okay, so with that joint venture partnership, right, we're going to form an LLC, right? We're going to get all the documents straight, get the bank account straight. And now, well, before that, around the same time, we're going to have to decide how we're going to invest or place that $200,000. Okay, so we're going in together. They put up the money and they sign for the loans. Just FYI for the capital investor. Me as the managing investor, I handle the operations, handle the transactions, helping to coordinate everything, manage the property or help oversee management of the asset, and then doing asset management and running the operations from there. Just heads up, you got capital investor, managing investor. Okay, so in the joint venture partnership arrangement, the investor has $200,000. Well, we're in the Kansas City market. My cup of tea, single family homes investments, B-class areas, some C-class areas, that 200 grand, we're gonna have to be strategic about how we put that to work, because essentially, if we're gonna go all cash, that basically gets us one house, okay? Or, whether you go a fixer-upper, buying the property, rehabbing it, or if you buy a property and it's ready to go, it's livable or turnkey, that 200 grand or approximately can get you basically one house. Well, you can use that same 200 grand, and if you're able to leverage it and place it effectively, you can end up, in our case, how we would propose doing it, we'll end up with at least 3 houses, okay? So that's the leverage route. The joint venture partnership, okay? We're gonna be looking at buying houses that are ready to go. This is just one way to do it. And we're going to be looking at putting 20 to 30% down. Okay, so in and around Kansas City, our bread and butter again, B-class single family homes. Okay, that 20 to 30% down payment, okay, plus reserves, plus placement fees, and commissions and so forth. You're going to be looking at spending somewhere between maybe $60,000 to $80,000, okay, to purchase one B-class single family home that's ready to go. Then from there, you can rent it out however you want to rent it, or you might look at doing something creative, which is again part of our specialty. It could be some type of seller financing from there. Okay, that's our number one way that we're pushing right now. Okay, so again, that's the joint venture partnership, leveraging that $200,000. $60,000 to $80,000 per property on houses that are ready to go. That's just one way to do it, okay, through the joint venture partnership. Another way to do it, which is very common and very popular, is to go the rehab refinance, or also known as the BRRRR strategy, where you are buying a property that's a fixer-upper, and you can, again, use that $200,000 on one property. Or you could leverage that $200,000, and instead of going the turnkey route and using long-term debt right off the bat, you could leverage the 200 grand to do the BRRRR strategy, the purchase, the renovation, the refinance, and you can leverage that 200 grand with some type of short-term debt. It doesn't necessarily have to be a hard money loan. It could be some other type of short-term debt, or it could be some type of bridge loan where you're able to do multiple properties using the value add or BRRRR strategy, where you're taking on renovations, getting through those, refinancing, then getting to cash flow, either with your rental or your seller financing from that point, okay? So you gotta determine, again, based on your risk tolerance, your capital investors' risk tolerance, your operational skills, how you want to move and operate, which way is going to be the way for you to go. You're going to do both. Doing both might work out pretty well for you too. But based on what's happening in your market, what's happening in the economy, again, your risk tolerance, operational skills, and so forth, how you want to make that happen, okay? So that's the joint venture partnership with the use of capital, going leveraged, using some type of loan, either on the short-term basis or a long-term basis, okay? And then, either doing turnkey value add, right? That's the joint venture partnership in a nutshell type of thing, right? Now, let's dig into the private money lending situation, okay? It's somewhat similar, okay? Let's take the example of the $200,000. There's the capital investor. They don't want to be necessarily as involved. Even though with the joint venture partnership, how we do it and how you can too, the capital investor is passive in a way, but they still have to have some involvement because they're going to need to sign closing documents. They're going to need to sign loan documents. There's going to be other things that they need to step in and assist with. Well, they may not necessarily want to go that route. They may want to go the private money lender route, where they still, I think that they still are going to have some type of involvement. It may not necessarily be completely passive, but it's got to be a little bit more passive than going the joint venture partnership route, okay? So with the private money lending route, you have a capital investor with $200,000. They just want to loan you the money, or they want, to loan someone the money, okay? Again, that $200,000, depending on how you utilize it or leverage it, in and around Kansas City, B-class, maybe some C-class single family homes. If in the example that I gave on the PowerPoint, and by the way, if you're interested, feel free to reach out, hit me up in the comments or reach out some other way. There's my contact information. If you want that PowerPoint or a version of it, I'd be happy to send it to you so you can kind of get a better idea of how that might look real time in the Kansas City market for what we're doing. Okay, so back to the private money lending situation. The capital investor has $200,000. They want to be more passive. They're going to loan that money to you, or they're going to loan that money to someone. All right, as I mentioned before, that loan might be unsecured, unlikely in a lot of cases. So that means it's very well, again, depending on how you want to operate and how you want to strategize and how you want to place that capital, that 200 grand, however it's split up, it could be one property, it could be multiple properties, but it's going to be secured in either first lien position or second lien position, okay? So if on the example in the PowerPoint that I gave for Kansas City single family home investments, I said if you have $150,000 or more, there's a very good chance that we can borrow that money and the lender, the capital investor, can be in first lien position. There's enough there to be in first lien position, okay? If they want to do smaller amounts, if they want to do 20 grand, 50 grand, 60 grand at a time, the figure I used on the PowerPoint was 100 grand. If you got 100 grand or less, there's a very, very good chance, not in all cases, but there's a good chance that you may be in second lien position. So does your lender, does your capital investor understand what that is? Do you understand what that is? What are the risks? What does that truly entail, and so forth, all right? So there's some similarities there for the operator or the investor, okay, right? But the difference is mostly for the capital investor, if they're gonna go joint venture or if they're gonna go private money lender, okay? So again, 200 grand, if they need to be in first lien position, there's a chance that we'll do one deal, okay, right? And depending on how, what rate that they're charging, the cost of the money, and then the terms of its usage, like how long the investor is willing and able to leave that particular amount of capital invested, helps determine how we can place it. Because, okay, that 200 grand is cool, but if they are going to charge me, 10 to 12%, and they need that back within 6 to 12 months, well, that's going to force my hand and it's going to limit me on what I do. Okay, so in that case, if they're going to charge or loan 200 grand and they're going to charge 10 to 12% and they need it back in 6 to 12 months, well, I pretty much either have to do something where I can turn the money. I can't leave necessarily all of that 200 grand tied up for very long. I had to get in and get out. So that limits me on what I can do. I'm gonna have to either do something short term. It could be a wholesale fix and flip type of thing, or I'm gonna have to utilize the renovate and refinance strategy because I have to get that money back out within a relatively short amount of time. So I'm gonna have to turn it, right, type of thing. On the flip side, if my capital investor, okay, let's say they are cool doing smaller loan amounts and they are okay with being in second lien position or perhaps unsecured, and they can leave that money invested for a longer period of time, let's say 5 to 10 years, as I gave on the example in my PowerPoint, well, that gives us some breathing room. We could be a little bit more flexible. We could kind of, take our time and find the right opportunities. And once we're in an opportunity, hopefully it's cash flowing, generating revenue, positive cash flow type of thing, then we can ride it out. And in actuality, I believe the longer term investments, when done effectively, when done well, will make a lot more money over time type of thing. All right. So I know I got into some of the pros and cons of either route that you take, whether you go the joint venture route or the private lender route, but I want to kind of dig in a little bit more on the pros and cons. All right. So let's see. For the joint venture partnership, some of the cons are, the capital investor has to be a little bit more involved, okay? There's going to be loan applications, signatures on documents, okay? Another con, there's a higher potential for losses, and some might consider there to be more risk as a property owner versus just a lender, okay? Some of the pros or benefits of going the joint venture partner route, you have, or at least the capital investor, you and your capital investor have a higher income potential for that investment, more cash flow, okay? And then you also have the opportunity for long-term benefits, such as such as appreciation. You got the depreciation in there. And then there's tax benefits for being a landlord or a housing provider, being an owner on that property. There's those tax benefits that the capital investor would not have if they just went the private money lender route, okay? So now for the private money lender, some of this will definitely tie over, but some of the cons, right? There's less overall revenue, as I mentioned before. There's no ownership, no tax benefits, nor other long-term benefits. There's no capital appreciation on being a private money lender. Okay, some of the pros, some of the good things about the private money lender route, there's less involvement for your capital investor. For them, it'll be a little easier to track and monitor how the capital is going in and going out. They don't have to worry about being involved with renovation projects, whether it's you as the managing investor handling that. They don't necessarily, your capital investor doesn't have to worry about going through renovation projects, no contractors to oversee, and then they also don't have to worry about tenants and properties to manage if they go the private money lender route. Now, is that less risk than the property owner? That's a good question. I mean, I guess it depends on the investment strategy, how that capital is being used. I've gone back and forth with some people trying to decide, is the private money lender taking more risk, or is the investor, the managing investor, whoever is actually running the operation and invest the capital, are they taking on risk or as much risk? I kind of have leaned toward the investor being the one that's taking on more of the risk, but I mean, you choose your battles. Like, you figure out which one is more risk for you, depending on how you're placing your capital. All right, and so just FYI, going a little bit deeper into how that might look for the Kansas City market, B-class single-family homes in and around KC could be in that 200,000 to 250,000, maybe a little bit higher, maybe a little bit lower on the current or after repair value. Okay, the cash flow that we're receiving for our long-term cash flow investments is in that $300 to $500 a range, $300 to $500 a month range. Okay, and something I didn't mention before on the private money lending opportunity, in most cases, the capital investor or lender is going to get a flat fee or a flat percentage rate of return on the loan that they're making, okay? So they're going to be somewhat limited on how much they can make, whereas as on the joint venture partnership route, the opportunity long-term, and when I say long-term, and I have to, state this so people understand, in order to get those juicier returns where you're talking double digits and up, we're stating that that's going to take a good 5 to 10 years at least to be able to see that. And so when you're looking at the investment as a whole, there's the returns, the cash flow, cash on cash in the short term, which may not necessarily seem that attractive for the JV partnership, for the owning properties for the long term with the limited cash flow, $300 to $500 a month. But as you are holding that investment and you get to enjoy all the other benefits, the depreciation, the appreciation, there's write-offs and so forth, there's other tax benefits as well. At the end of that investment, when you exit or when you get paid out, or however that looks, that's when you really get to look at, and you can look back and say, okay, we bought this investment, we rented it out, or we did seller financing, and we held that for 6 years, let's say. And at the 6-year mark, our buyers, refinanced, or our seller finance buyers got their own funding, or they defaulted and we end up selling the property. Well, at that point, at the end of that cycle, you can then look back over that 6-year period and look at what your overall rate of return, cash on cash, internal rate of return, that sort of thing. And I think you'll be pleased, right? So of course, we usually lean towards joint venture partnership, but we're currently doing both of these as we speak for the private lending opportunities as well as joint venture partnership opportunities. So, choose how you want to operate. And if you want to dig in deeper, feel free to reach out. Again, it's Luther Wilson III, Upside Property Services, Kansas City Real Estate. Stay blessed, y'all. Peace.